Right now, if you open up any financial news site or turn on CNBC, the story you're going to hear is pretty consistent. The American economy is doing just fine. Unemployment is low, consumers are still spending, and sure, maybe things aren't as red hot as they were a year ago, but overall, we're in pretty good shape. And on the surface, that story makes sense, because if you zoom out and squint a little, the headline numbers look stable. But here's the problem. The headline numbers are only half the story. And if you actually dig into what's happening beneath the surface, what you start to see is something very different. You start to see an economy that's a lot more fragile than anyone wants to admit, because the cracks aren't showing up in some catastrophic collapse or a dramatic market crash. They're showing up in slower hiring, a softer real growth, strained household budgets, and a government that's borrowing hundreds of billions just to keep the lights on. And none of that feels like a crisis yet, which is exactly why it's dangerous. Because fragility doesn't announce itself with fireworks. It builds quietly. And then one day, something small tips over, and suddenly everyone's asking how we didn't see it coming. So let's start with the labor market, because for the last 2 years, the story has been that jobs are strong and the unemployment rate is manageable, and for a while that was true. But on March 6th, the Bureau of Labor Statistics released the February employment report, and it told a very different story. Total non-farm payroll employment didn't rise. It edged down by 92,000 jobs. And if you've been paying attention to employment data over the last few years, you know that's not normal. Because even in slow months, payrolls usually go up. They might go up by 50,000 or 100,000, but they go up. A negative print isn't just weak, it's a reversal. And it's not like this happened in isolation either, because the unemployment rate in February came in at 4.4%, which is still relatively low by historical standards, but it's also noticeably higher than where it was a year ago. And here's where it gets more concerning. The same report showed that the number of long-term unemployed workers, people who've been out of work for 27 weeks or longer, totaled 1.9 million in February. And that's up from 1.5 million a year earlier. So we're not just talking about people losing jobs and finding new ones quickly. We're talking about people who are staying unemployed for longer periods of time. And that matters because long-term unemployment is one of those quiet indicators that tells you something structural is starting to break. It means companies aren't hiring as aggressively. It means job openings are shrinking. And it means that even if the headline unemployment rate looks fine, the underlying labor market is softening in ways that don't show up in the top-line number. But it's not just private sector employment that's slowing down. The same BLS report also revealed that federal government employment in February was down by 330,000 jobs from its peak back in October of 2024. And that's a massive drop in a very short period of time. Because government employment doesn't usually swing that dramatically unless there's a deliberate policy shift or budget cuts happening behind the scenes. And whether you think that's good or bad, policy is beside the point. What matters is that it's another 330,000 paychecks that aren't being deposited anymore. And it's not just the federal government either. Transportation and warehousing employment, which had been one of the stronger sectors coming out of the pandemic, had fallen by 157,000 jobs from its peak in February of 2025. So you've got federal workers getting cut, logistics jobs disappearing, and long-term unemployment rising. And all of this is happening at the same time, which means the labor market isn't collapsing, but it's definitely not strong either. It's softening. And in an economy where consumer spending drives roughly 70% of GDP, a softening labor market is a problem because people who are worried about their jobs don't spend money the same way people who feel secure do. They pull back. They save more. They wait. And when enough people start doing that at the same time, it shows up in the data. Which brings us to consumer spending, because this is where the fragility really starts to show. On March 13th, The Bureau of Economic Analysis released personal income and spending data for January, and on the surface it looked fine. Personal income rose 0.4%. Disposable personal income rose 0.9%. And personal consumption expenditures also rose 0.4%. So at first glance, you'd think consumers are doing okay. But then you look at real personal consumption expenditures, which adjusts for inflation, and that number only rose 0.1%. And that's a massive difference. Because it means that even though people are spending more in nominal terms, they're not actually consuming more in real terms. They're just paying higher prices for the same stuff. And that's not a sign of a healthy, growing economy. That's a sign of an economy where inflation is eating into purchasing power faster than incomes are rising. And speaking of inflation, the same report showed that headline PCE inflation came in at 2.8% year over year. And core PCE, which strips out food and energy, was at 3.1%. And both of those numbers are still well above the Federal Reserve's 2% target. So inflation isn't spiraling out of control, but it's also not going away. It's just sitting there, sticky and stubborn, making everything more expensive while real income growth stalls out. And here's the part that should make you uncomfortable. The personal saving rate in January was 4.5%. And that might not sound alarming, but context matters. Because during the pandemic, when stimulus checks were flying out the door and people were stuck at home, the saving rate spiked above 30%. Then it crashed as people went back to spending. And now it's sitting at 4.5%, which is below the long-term average. So consumers aren't just spending more because they're confident. They're spending more because they have to. And they're doing it by saving less. And when people are saving less, while inflation stays elevated and the job market softens, that's not resilience. That's fragility. Because if something goes wrong, if layoffs accelerate or prices spike again, there's no cushion left. People are already running close to the edge. Now, let's talk about growth, because this is where the story really starts to fall apart. On February 20th, the Bureau of Economic Analysis reported that real GDP grew at an annual rate of 1.4% in the fourth quarter of 2025. And if you've been following economic data over the last few years, you know that's a sharp deceleration, because in the third quarter of 2025, GDP grew at 4.4% and a day. So we went from 4.4% growth to 1.4% growth in a single quarter. That's not a soft landing. That's a hard break. And it gets worse. The same report showed that real final sales to private domestic purchasers, which is a measure of underlying demand that strips out inventories and government spending, rose just 2.4%. So even when you look at the cleanest measure of private sector demand, growth is slowing. And for the full year of 2025, real GDP growth came in at 2.2%, down from 2.8% in 2024. So the trend is clear. Growth is decelerating. And it's not decelerating because the economy is stabilizing at a healthy level. It's decelerating because the drivers of growth are weakening. And here's why that matters. Because in an economy that's built on consumer spending, business investment, and government support, when all three of those things start to slow down at the same time, you don't get a plateau. You get a slide. And the slide doesn't have to be dramatic to be dangerous. Because once growth momentum shifts from accelerating to decelerating, it becomes much harder to reverse. Business confidence drops. Hiring slows. Investment plans get delayed. And all of those things feed back into the cycle, making the slowdown worse. It's not a collapse. It's a grind. And grinds are dangerous because they're boring. Nobody panics. Nobody sounds the alarm. People just assume things will get better eventually. But eventually doesn't show up on its own. It requires either a policy response or a fundamental shift in the economy. And right now, there's no sign of either. Which brings us to the government, because while the private sector is slowing down, the public sector is doing something very different. It's borrowing. A lot. On February 2nd, the Treasury Department announced that it expected to borrow $574 billion in privately held net marketable debt in the January to March quarter of 2026, and then another $109 billion in the April to June quarter. So we're talking about nearly $700 billion in new borrowing in just 6 months. And that's not emergency pandemic spending. That's just regular operations. Because the federal government is running a structural deficit, which means it spends more than it collects in taxes every single year. And to cover that gap, it has to issue debt. Lots of it. And the problem isn't just the amount of borrowing, it's the timing. Because the Treasury is flooding the market with new debt at the same time that the Federal Reserve is no longer buying bonds. And when supply goes up and demand doesn't, prices fall and yields rise. And higher yields mean higher borrowing costs for the government, which means more of the budget goes toward paying interest on the debt instead of funding programs or investments. And it also means higher yields for everything else. Mortgages, corporate bonds, car loans, all of it gets more expensive. So the government's borrowing needs aren't just a fiscal problem. They're a financial conditions problem. And tighter financial conditions slow down the economy even more. Which brings in less tax revenue, which forces the government to borrow even more. It's a feedback loop, and it's not sustainable. So here's where we are. The labor market is softening. Long-term unemployment is rising. Consumer spending is only growing in nominal terms, while real spending is flat. Inflation is still sticky. The saving rate is below average. GDP growth is decelerating. And the government is borrowing hundreds of billions of dollars every quarter just to keep the machine running. And none of that is catastrophic on its own. But that's the point. Fragility doesn't show up as one big break. It shows up as a dozen small cracks that all start connecting at the same time. Because when the labor market softens, people spend less. When people spend less, businesses pull back. When businesses pull back, they hire fewer people. And when they hire fewer people, the labor market softens even more. It's all connected. And the problem with a fragile system is that it doesn't take much to tip it over. It could be a policy mistake. It could be a geopolitical shock. It could be a financial market event that nobody saw coming. Or it could just be the slow accumulation of weak data points that eventually add up to something bigger. And that's also why people keep getting fooled by the wrong scoreboards. They look at the stock market, see a few indexes holding up, and assume the economy must be healthier than it feels. But markets are not the same thing as broad economic strength. A handful of massive companies can push an index higher, while households get squeezed, hiring slows, and small businesses lose momentum. Asset prices respond to liquidity and expectations. Families respond to rent, groceries, job security, and debt payments. Those are not the same reality. So, when Wall Street looks okay but Main Street feels tight, that isn't a contradiction. That's usually the warning. And here's the uncomfortable truth. The economy doesn't have to collapse for things to get bad. It just has to stop growing. Because in a system built on the assumption of perpetual growth, stagnation is its own kind of crisis. Businesses stop investing. Workers stop getting raises. Debt becomes harder to service. And the political pressure to do something, anything, becomes overwhelming. And that's when mistakes get made. That's when policymakers panic and overcorrect. That's when fragile systems break. So no, the American economy isn't collapsing. But it's also not as solid as the headlines suggest. Because underneath the stable surface, the foundation is shifting. The cracks are forming. And the margin for error is shrinking. And maybe everything holds together. Maybe growth picks back up, inflation cools, and the labor market stabilizes. But maybe it doesn't. And if it doesn't, the question isn't whether the economy can handle one shock. It's whether it can handle the next one. Because fragile systems don't fail when everything is going wrong. They fail when just enough things go wrong at the same time. And right now, we're a lot closer to that threshold than most people realize.